Hello, everyone, and thank you so much for joining us for this anniversary webinar celebrating our 15 years of ETF investing. I'm Margaret Sargent, Senior Marketing Associate here at New Frontier, and I am very pleased to be joined today by our CIO, Robert Michaud, who will be sharing a look back at how the ETF investing landscape and New Frontier's own portfolios have evolved over the last 15 years. Just a quick housekeeping note before we begin. Your lines will be muted for the duration of the call just to reduce background noise. So if you have questions, please submit those using the chat feature of GoToWebinar, and we'll have some time for Q&A at the end. So without further ado, I will let Robert kick things off.
All right. Thank you, Margaret. So we're here. Thanks for coming. I wanted to do this because I was pretty excited about hitting a 15th anniversary. I realize that this is just about the longest ETF portfolio track record that anyone has out there, and started thinking back on how things have changed, how our portfolio is different today than it was, and how actually ETFs are different, how the industry is different, how really just about everything is different today than it was now, and including some of the things about in our research and our investment process have also evolved over time. And so I thought it would be interesting to go into that. And so you've probably are aware that ETFs have proliferated. ETF strategies have also become much more popular. If you look at this graph, and you can see that at the beginning, when we started, there were really not very much assets or of any kind in ETF strategies. And that was a pretty broad definition of them. So now there are household names. So things were different. Let's start at the beginning. Without to get too metaphysical, we want to say that not too many people really can give this type of perspective. Not too many people who have the same firm, the same management team, the same portfolios for the last 15 years in the ETF world. And so we're really one of the few who can tell this story. So, but why? How did that happen? How did we get to be one of these, one of the few who are still here? And I think part of this is that we've had a consistent philosophy, but we've always tried to improve the portfolios. We've tried to, that includes evolving with new investment information, so not just staying stuck in the past. Keep innovating through both research and technology. And right from the start, we were using ETFs for the right reasons, not because they were trendy or great ways to make big bets, but because they were really the most efficient way to implement our ideas and the ideas of institutional asset management. And this allowed us to have better diversification and risk management through optimization. And unlike some other firms that are all based on a principal who has strong opinions or likes to make big bets, we really are about adding investment value that's backed by a mathematical simulation proof. And optimization is not just an opinion, it's math. So, and it turns out it works. 15 years ago, every strategy that we started still exists, and we're quite proud of our short and our long-term performance. And sort of one of the final chapters is that we actually have an index of ETFs here, which provides even more transparency into the investment process. So these are all neat things to talk about. So why did it start in 2004? And I think this is, like other things, sort of there were a confluence of events that happened that made it possible. So we had technology platforms that were really emerging to support financial advisors. After the dot-com era bubble burst, when everybody said, oh, I can just become a millionaire through day trading, there became a demand for professionally managed portfolios. And this was sort of the continuing evolution of wealth management, where you move from individual stocks to maybe portfolios of stocks to trying to pick mutual funds to more thoughtful asset allocation strategies that are really thinking about things at a higher level. And another very important thing is that there weren't any fixed income ETFs until just about 2004. So if you're So we knew that ETFs were growing in popularity back then. You've probably seen this, but you may not have realized that fixed income ETFs were not very popular in 2004. And you can't build a global multi-asset portfolio without half of the asset classes out there. And so this is I think, a pretty telling graph that you really couldn't have done it much sooner. So 2004 it is. And how did we get started back then? Well, we were known for our research, our technology, and our institutional investment background. And we had gotten many offers from people who followed our research. There were the snarky ones that said, if you're so smart, how come you're not managing money? And there were the much kinder ones who said, we like your ideas. Is there an investment strategy that's appropriate? But the principals have had experience in the international small cap quantitative investment market, and that is a lot of work. And so we were not really ready to build all of the infrastructure, the armies of people to do compliance and accounting and everything else necessary to start an investment firm. And so we turned these down. But then my father remembers this quite well. The CEO of AssetMark, Brian O'Toole, he called him up one day and said, I'm telling his story, but I think it's accurate. He said, Dick, you don't know me, but I've been following your research for years, and I think you guys are the perfect person to build a global multi-asset portfolio, an optimized portfolio of ETFs. And it didn't take us long to wholeheartedly agree. We were excited to have a platform that could bring institutional ideas to a retail audience, and it let us do what we do best, asset management, and implement our user optimization, and it worked quite well. So that was a offer to get started into the investment management business that we could not pass up. And so then we wanted to build a good product. We wanted to leverage everything that we had. We had the research, the technology, academic and institutional investment backgrounds, but we did not have a global network of analysts and economists. So that meant we're not going to be trying to think that we're smarter than the markets. So we're going to have a global perspective and be style agnostic. And another thing going on at the time is we personally had a very nice technology business going on, and this would be a great way to really leverage the optimizer and show just how powerful good optimization can be when you're not claiming to know things that the rest of the market doesn't. So we had to take the ideas of the institutional world and build institutional portfolios for retail investors. And this was really pretty novel. It was to move away from focusing on stocks or funds to thinking about the whole portfolio. Even today, not everyone's comfortable with just ignoring one position in their portfolio and thinking about the whole portfolio. But this is really the right answer. Think about the portfolio, not the fund. Focus on long-term optimality, all while providing efficient short-term exposure. And ETFs were really the perfect instrument for it. You can think of them as ego-free. These are ETFs, don't reflect the opinions of portfolio managers, are just supposed to be a nice transparent workhorse doing their job effectively. And so ETFs were really the right building block for building these institutional portfolios. So we wanted to invest with markets. We wanted to return through exposure to risk premium. Of course, diversification and long-term efficiency, and using optimization to its fullest extent. So again, this is moving from a simple sort of market-based asset allocation, which got filled up with active funds, and we wanted to push the institutional asset management framework to something more effective, which is build a really sophisticated asset allocation, but instead use passive ETFs that can efficiently, cost-effectively, transparently give you exposure to the risk premia that you're looking for. And we can do our risk management through asset allocation. So what does the journey look like? Well, back in 2004, I hope we don't hear the word EFT too much anymore, but that was all over the place. The people were really excited about it and had no idea what it was. So we wanted to overcome, we spent a lot of time trying to overcome the confusion of the ETF strategy and sort of disambiguate what an ETF is from what a portfolio of ETFs or a strategy of ETFs is. And you would get a lot of people who would say, well, if you're a strategic manager using ETFs or a tactical manager using ETFs, you're all using ETFs, so aren't you the same thing? And to me, that was a pretty absurd question, but from their perspective, where ETFs were such a new thing, it made sense. And we were all marketed as just an ETF portfolio. So, but the two main types of ways that people would use ETFs in the early days was just take some sort of existing asset management process, usually like a vanilla strategic asset management that the institutions would do. But instead of doing all the work of trying to find active managed mutual funds, just fill the boxes up with ETFs. That was one thing. The other thing was ETFs provide far more liquidity to move in and out of commodities or international markets than you had previously. And so it made it a great instrument for sort of tactical managers. And those were the two things. We wanted to do something, of course, or we did do something, of course, that was, I think, a little bit more interesting than either of those. But again, just going back to the time, though, even global investing was kind of new. People tended to compare everything to the S&P 500, and this continued for a while. And literally half of our investment presentations were about ETF suitability, and what is an ETF. So this era ended for me in 2007, not because of the looming financial crisis, but because that's when we hit sort of a critical mass of education. And I remember going on vacation over the summer of 2007, where using the same presentation after the break in the fall that we had been using in the spring. And then people said, hey, we know what an ETF is already. And that was the end of the early years for me. So there were, then the financial crisis came, and we managed to weather it reasonably well. And there was one thing that put some perspective of the past of this on me is in 2008, all the companies on this list were pretty well known to me. And now there's only 3 left. And so I think one of the reasons why looking at the people who are still here is that they did stick, and of course we're in this group of we stuck to our principles, we stuck to our process, and a process that worked. So after the crisis, people were panicking. It was a very painful memory for everybody, and so people wanted to make sure it didn't happen again, and that kind of gave rise to the black box market timing strategies, and everyone was looking for a silver bullet, and but people did eventually get tired of that, and they say, please don't tell me you're going to protect on the downside and participate in the upside. And I said, don't worry, I'm not going to tell you that. So that played itself out, and today I think we're in a world where the different ETF strategies have really normalized, where we have a nice variety of different types of strategies and opinions out there for investors. So then and now, back then, I think about how the platform trading technology. We had to email a spreadsheet 2 weeks before the end of the quarter. And now we can securely, there's technology to securely transmit these things over the web. You had to give weights in 1% increments. Now you can put in any number you want. Fortunately, it's automatically checked for you so that your numbers make sure that they add up and that you're investing in all the right things. Back then, you had to be a little more careful. Once you finally got your trades in, then you'd hope that they would get traded the second Tuesday of the next quarter, or maybe it would be Wednesday if things didn't go so well. But Now you submit your trades and they happen minutes or hours later. This is and trading has improved too. This is a very different world. The ETFs themselves, back then, it was difficult to know just how liquid they were. You'd pay a lot of attention, and you'd want to make sure that you had the best liquidity possible. But the markets weren't as thick as they are now, and there would be wide spreads, and liquidity would vary from day to day. Today, liquidity is much more consistent. Back then, everyone was kind of on their own. There was no uniform way of thinking about these things. Now, Bloomberg, BlackRock, et cetera, have pre-trade analysis, where back then, if you were doing a large trade, a large swap from one type of ETF to another, then you were breaking new ground. Now we have a big database, all sorts of history of, well, if you want to do a $100 million trade from this ETF to that ETF, probably someone else has done it, and you can see what it's likely to look like. And the answer is usually pretty good. Just thinking about, on the other side, thinking about commissions. When we just started, Schwab had just made a breakthrough in terms of lowering commissions from $29.95 to $19.95. Down to $12.95. In 2010, they fell again, and then in 2017, they went from $6.95 to $4.95 in rapid succession, I think because TD maybe met their price and they fired back. And so I think of these things as the free trade wars, and the free trade wars are hopefully calming down at zero. And all the while, recently in the background, there had been parallel things where they're pushing for proprietary ETFs and free trade platforms, but the free trade wars have pretty much gone and made those obsolete. So the ETFs themselves, obviously, there were far more today than in the past. They're far more expensive in the past than they are now. The liquidity is better. The other thing is that there's a much greater variety. So back then, they were pretty much all market weight ETFs, and now you can get exposures to different risk factors, different styles, as well as pretty much any major asset class. And most importantly, fixed income was just proven. Major asset management firms were publicly saying that they're not even sure that fixed income ETFs can work, and they were slow to enter the business. And so now fixed income ETFs are ubiquitous, and in many ways even more so than stock ETFs, really the best way to access this asset class. And but the skepticism, one of the ways it exhibited itself is people would talk about ETFs being above or below NAV. So if net asset value. So if they were below their net asset value, then that was supposed to be an indication that the ETF wasn't trading well or something was wrong with it. Now that's really flipped the other way around, which is ETFs are so liquid, that's where all the pricing information is coming. So it's really the best way to know what's going on in markets that are closed overnight, illiquid asset class like high yield bonds, and times like on Veterans Day when bonds don't trade, who knows what's going on with the prices. And just to give you a nice example of that, Monday was Veterans Day, and so I went online at noon to check a few of my favorite ETFs out there, or I have many favorite ETFs. I love them all. These are nice ETFs. These are fixed income ETFs. The point is that the bonds underlying these things weren't trading at all during the day. Every single one I looked at, the bid-ask spread was 1 penny. This is low liquidity. So this is for these ETFs. So this is saying that really something has gone on and the world has really changed, and that ETFs have changed the game in terms of giving information about what's going on in an asset class. Something that I thought this might be a little bit more dramatic, but this is Morningstar's data, so what can I do? But still, the average asset weight ETF expense ratio has almost fallen in half over the last 10 years. Now, the ETFs themselves, in 2004, we had 12 ETFs in our balanced portfolio, and we were happy to have them. But those represented pretty much every good ETF, or just about every good ETF out there. Now there's 27 ETFs in our portfolio, and there are whole asset classes that we have to just turn down in the interests of parsimony to make sure that we can maintain the quality of our portfolios in them. And never mind that there are excellent quality ETFs from most major ETF providers for most major asset classes that all have perfect, great liquidity, low fees, and track a really good index. That compares to back then, where we had to be very careful in picking and choosing and across all the different providers, because each one only had a handful of best-in-class ETFs. Bond ETFs, very different. The knowledge of ETFs is very different. And there were big barriers to entry, actually. So it was hard to make an ETF. Only companies that were willing to consider an enormous amount of resources, go through a lot of legal hoops, could do it. And another recent development is that exemptive release is no longer required. Now, just looking, if you just put a magnascope on our portfolio and look at it, you can see that there's been sort of consistent changes. In 2007, we split out international into Europe and Pacific, added mortgage-backed. 2008, more bonds and international small cap. 2008 also, we could, for some reason, put half percentages in our portfolio now, which was an improvement. Get a little closer to optimal. Then we had 2009, we had high yield and gold, diversifying our portfolio better. Then we finally got our decimal points and the ability to trade at any points during a quarter. So that was a major improvement. And then we had long bonds, emerging bonds, China, single country ETFs, bank loans that came and went from our portfolio, short high yield, and more recently, min-vol in our portfolio. So very different sorts of asset classes today in the past. So this is really too much to go into and too much details, but we wrote our book in 1998. We continued to do research. We built the first version of the software in 2000. We started building ETF portfolios in 2004. Second edition of the book had an improved rebalance test. We improved statistical estimation, incorporated new research. We had more optimization procedures. And then in 2012, we built what we call a robot, which allowed us to monitor every portfolio every day using the brand new version of our rebalance test, which really had a greater insight into what was going on. We updated our capital market estimation procedures so we could really stay much more up to date and take advantage of the new technology that was allowing us to be more responsive with trades. And then we continued to update optimization procedures even to this day. So the products have really settled. There have been ETNs, smart beta, thematic ETFs, factory ETFs. Those things have been popular, and now I think they're in a better place where we have not just a wild west land grab for each of these things, but we have more thoughtful versions of them. K1s used to be like landmines in ETFs that needed to be avoided, and now the industry knows that. And taxes, I think, are one of the places where ETFs were always tax efficient, especially on the ETF providers took advantage of the ability for them to trade in kind. And they were a great improvement over mutual funds just structurally in that what other investors didn't affect you. But this just recently, I got the first new milestone, which is that State Street managed to have zero capital gains in their entire lineup, and the other big providers were not far behind. And there are a couple types of ETFs that I think they can be forgiven for if you have forward contracts for currency hedging or something like that. Well, that's I don't think anyone knows how to avoid capital gains from that. But I think ETFs have made it so that they're as tax efficient as they can get, or maybe someone will prove me wrong. But there's today a very healthy ecosystem of ETF strategies, of platforms, of advisors who understand them, and the continued move towards fee-based investing has, of course, encouraged this. So the last thing I want to talk about are our indices. And so I think this is I don't know if it's the final chapter, but this is the most recent chapter for us as a way to really improve the transparency here. So we've built indices of ETFs. So everything inside it is an ETF. So you get real-time pricing from liquid ETFs representing global markets. So you have pricing for the illiquid assets in closed markets around the world. And if you think about this, you have, U.S. stock exchange traded things. Nothing has a price more stale than a couple seconds in the portfolio. And if you wanted to compare this to somebody who's looking at a terminal, watching the news, and wondering what's happening to global markets, if you're looking at ACWI, you have more than 2,000 stocks that are all around the world. Some of them will have stale prices. Well, in fact, quite a few of them will have stale prices because their markets will be closed, and some of them will have stale prices for even worse reasons. Compare that to our global equity index, and you have something that's much more reactive, much more real time. If you think about our global balanced index, you have a optimized institutional balanced portfolio, and I've seen institutions say that they put our index on their phone and their watch. Look, oopsie, can I show you this? I can't. But there is a little green squiggle on my watch, and that represents right now what's going on in one of our global portfolios, and it does give you a real-time insight into what's going on in a risk-targeted portfolio, an optimized multi-asset global risk-targeted portfolio. So with that, I think I can end. Maybe we'll have some questions.
Great, thanks, Robert. So just as a reminder, your lines are muted. So if you do have any questions, please feel free to submit those using the chat feature of GoToWebinar. And just maybe while people want to send those in, I can share just a couple quick notes from marketing. So the indices that Robert just mentioned, you can find all of those on Bloomberg, on Yahoo Finance, wherever you typically look for your index information. You can find all 6 of those ETF global indices. And then just to highlight one upcoming event, we have in March, on March 12th, we will be hosting an asset allocation workshop here in Boston that will feature Robert as the instructor and will offer a really great educational opportunity to look at best practices for portfolio construction, monitoring, and rebalancing, all using New Frontier's own multi-patented investment technology. So I encourage all of you to keep an eye out for more information about that. That will be coming very soon. And of course, you can always find information on upcoming events on the event page of our website under the News and Insights tab. So it looks like we don't have any questions. If anything occurs to you after we sign off, please feel free to send those questions in. We're happy to continue the conversation. So thank you all so much for dialing in today, and we will see you on the next webinar. Have a great day.